What if I told you that two people could start with the exact same amount of money, make completely different investment decisions, and end up in almost the same place 20 years later, but with completely different lives along the way? That's not a hypothetical. That's exactly what happens when you put real estate and stocks head-to-head with honest numbers. No cherry-picked scenarios, no influencer bias, just the full picture. And trust me, some of what you're about to hear is going to challenge everything you thought you knew about building wealth. Let's set the scene. Two guys, same age, same city, same income, around $55,000 a year, and both of them just saved up $50,000. One puts it into a rental property, the other drops it into a total stock market index fund. Same starting line, completely different journeys. Let's follow both of them. The real estate guy uses his $50,000 as a down payment on a $250,000 home. He gets a 30-year mortgage at 7% interest, finds a tenant paying $1,800 a month, and his mortgage payment sits around $1,330. On paper, that's almost $500 a month in profit before anything else. He feels like a genius. He drives past that house on the way to work and thinks about the fact that he owns it. His friends are impressed. He's talking about it at every social gathering. Meanwhile, the stock market guy puts his $50,000 into an index fund, sets up a $300 monthly contribution, and basically forgets about it. His friends nod politely when he mentions it and immediately change the subject. Day one. It's not even a competition in terms of how things feel. But here's where the real estate story gets complicated. That $470 monthly profit sounds amazing until you start subtracting reality. Property taxes, insurance, maintenance, those alone chip away significantly. Then there's the water heater that needs replacing, the roof that starts leaking, the month between tenants where you're paying a mortgage with zero rental income coming in. And if you manage the property yourself, you're essentially working a part-time job on nights and weekends with zero additional pay. If you hire a property manager, there goes 8 to 10% of your rent every single month. By year 3, after accounting for all real expenses, not the napkin math, but the actual dollars, the landlord's net cash flow is somewhere between $2,000 and $4,000 total. Not per year, total over 3 years. Compare that to the index fund investor, who now has roughly $76,000 in his portfolio, just by doing absolutely nothing except letting compounding work. But hold on, because the real estate story isn't finished. There's something powerful happening on the property side that the numbers above don't capture: leverage. The landlord used $50,000 to control a $250,000 asset. When that property appreciates 3 to 4% annually, those gains apply to the full property value, not just his down payment. By year 3, the property might be worth somewhere around $270,000 to $280,000. His equity has grown to $55,000 or $65,000. That's real wealth created partly with borrowed money, and it's an advantage the stock market simply can't replicate in the same way. Now let's fast forward to year 10. The property is worth somewhere around $335,000 to $350,000. After accounting for the remaining mortgage balance, equity lands around $170,000 to $184,000. But the landlord has also spent somewhere between $20,000 and $35,000 out of pocket beyond the original down payment, covering repairs, vacancies, capital expenditures like roof replacements and HVAC systems, and all the costs that never show up on the YouTube thumbnail. The index fund investor at year 10, with consistent monthly contributions and a roughly 10% average annual return, is sitting on approximately $165,000 to $180,000. He put in $86,000 total between the initial investment and his monthly contributions. Everything else is pure compounding, and he spent exactly 0 weekends dealing with plumbing emergencies. At year 10, they're surprisingly close in total wealth. The landlord might have a slight edge thanks to leverage, but the landlord also concentrated his entire investment into one asset in one zip code, took on hundreds of thousands in debt, and sacrificed countless hours of his time. The stock investor is diversified across thousands of companies worldwide and could liquidate his entire position in minutes if he needed to. Year 20 is where things get truly interesting. The property is now worth somewhere between $450,000 and $500,000. With the mortgage nearly paid off, equity could be anywhere from $400,000 to $500,000. Factor in 20 years of maintenance, multiple tenant turnovers, at least one major renovation, ongoing taxes and insurance, and the net cash flow above expenses over that entire period might land between $40,000 and $80,000. The index fund investor, with that 10% average annual return and $300 monthly over 20 years, the portfolio grows to approximately $420,000 to $460,000. Total contributions over 20 years were $122,000. The remaining $300,000+ is pure compound growth. No debt, no tenants, no late-night emergency calls. Let me pause here for a second and share something you need to see. The housing market in 2026 isn't just a little tight. We're talking about a shortage of more than 7 million affordable homes for over 10.8 million extremely low-income families. Yes, the math is doing that thing again where it just doesn't add up and somehow still wins every time. Now, we could stay here and unpack all the gaps, the policies, the supply issues, and probably need a whiteboard, 3 coffees, and a stress ball. But if you really want to understand the root cause, what's actually driving this mess, and why it keeps getting worse, I put together a full breakdown in this What's Really Happening to the Housing Market in 2026 video. We go into some of the most uncomfortable truths about the housing market in 2026. The kind of stuff nobody in real estate ads wants to talk about. If you're genuinely interested in what's really going on and not just the headlines, you're going to want to watch that one. Here's what's wild. In terms of net worth, they both end up somewhere in the $400,000 to $500,000 range. The destination is similar, but the journey is dramatically different. One person worked for their wealth, the other waited for it. And if the index fund investor had bumped his monthly contribution up by just $200 to $500 per month, his 20-year total jumps to $550,000 to $600,000. In real estate, increasing your investment typically means buying another property and doubling your workload. In the stock market, increasing your contribution just means typing in a higher number. Now, to be fair, stocks have real risks that deserve honest attention. In 2008, the market dropped 37%. In early 2020, it fell 34% in just a matter of weeks. Watching your portfolio drop from $150,000 to $95,000 is genuinely gut-wrenching. And research consistently shows that most everyday investors panic and sell at exactly the wrong moment, locking in losses before the recovery ever comes. There's also no cash flow. Index funds don't send you a monthly check. Dividends on a total market fund are roughly 1.5% to 2% annually. Helpful, but nowhere near income replacement. Real estate, when done right, has genuine advantages. Leverage amplifies your returns when values rise. Depreciation lets you deduct a theoretical loss from your taxable income even while the property is actually appreciating in value, something stock investors simply don't have access to. Strategies like house hacking, where you live in one unit and rent others, can reduce your housing costs to near zero while building equity simultaneously. And tools like 1031 exchanges allow you to defer capital gains taxes by rolling proceeds into new properties, creating tax-advantaged compounding that mirrors what retirement accounts offer stock investors. So which one actually builds more wealth? The honest answer is that both can, but only when you go in with clear eyes about what each one actually costs, in dollars, in time, in stress, and in risk. The real danger isn't picking real estate or picking stocks. The danger is making that decision based on a headline, a podcast clip, or someone bragging at a barbecue without ever sitting down and doing the full math for your specific situation. Because when you include everything, every repair, every crash, every sleepless night, every compound gain, the answer might surprise you. And the follow-up question, what happens when you do both at the same time, might change everything you think you know about this entire debate.